Welcome to the Daily Update. This is Being Prepared Friday, October 28th, where we'll look at the action in the market today and then see how things look for Monday, October 31st. And we had a pretty strong up day. My goodness. Now, the markets had every reason to go lower. The economic reports that came out, there were some earnings reports that came out, and just all of the headwinds that the markets are facing right now, there could have been justification for prices to go much lower, but it seems like a lot of the bad news, the expectations of what the Fed might do, the decline in earnings, a lot of that's already been baked into the market or discounted into the market. And so things are turning more positive, and they just decided to do more buying than selling on Friday. So we saw a really strong update. So let's go back and talk about what happened. We did have a higher open, and we went right up to the daily pivot at 38.24. And then we pretty quickly went right up to R1 at 38.44. So we're getting well into the 3800s now for the S&P. As the day went on, we went up to R2 at 38.80, and then we got right up to 3900. We went above R2. That's more psychological, but it's also turning into a technical level, and there's a lot of strike prices right around those levels as well. And that's now the overhead resistance if prices continue to go up. Now, in the short term, yeah, we're becoming more oversold, more overbought than we have been, but the market that can still go up even when it's overbought, that's a pretty positive sign. Going into the close, we closed right near the high, just a little bit off of it, and we ended up being up 2.46% on above average volume. The technicals are turning much more positive now, but as I said, short term, we're still looking a little toppy. We may see a bit of a decline. We're right below 3,900, but things are shifting and looking a lot better with our charts, and I'll go through those. Of course, the big thing now, which is what it has been, are inflation and interest rates. And we've got the Fed meeting this week. They will make an announcement. It's pretty much expected. They're going to raise rates 75 basis points or 0.75%. And then the market will have its gyration initially. And then, about a half hour or so after they make the announcement, there will be a press conference. And then the markets will be hanging on every word and either taking things higher or lower, depending on what is said during Jerome Powell's press conference. So right now, though, ahead of that meeting, you're not going to hear anything from the Fed because they're on lockdown. We still have the geopolitical concerns, Russia, Ukraine, and that, of course, is pretty bad, and it could even escalate more than what it already is. But right now, it's not having an impact on the markets. And then the midterm election, which is coming up this week as well. So there's a lot of things happening, and usually the markets don't really react to elections all that much. That's more longer term with what kind of policy is going to be implemented, what kind of economic decisions are going to be made. So unless the markets are really caught off guard, like what happened in the 2016 election, they don't really react to an election. And then the market didn't necessarily react negatively. Most of what happened in 2016 was in the overnight session. So if you looked at from one day to the next, there really wasn't all that much of a change. It all went in the after hours and overnight session. And that wasn't either positive or negative. It was just shifting because Donald Trump ended up winning where everybody thought Hillary Clinton was going to win. And so the markets were geared up for Hillary Clinton to win. She didn't. And so companies wanted to adjust, now realizing that Donald Trump won. So it was just more of a rebalancing more than an actual reaction to what happened. And something like that might happen this week as well. So some comments. Stocks rose in spite of bad earnings coming out from Amazon. That could have really justified things going lower. And we had rising interest rates. That's been a real headwind for stocks. Well, it wasn't on Friday. And one thing that is a little concerning that may mean that we've gone up a little too far, too fast, the VIX is becoming oversold, which means it's been really declining. now. And when the VIX is low, it's time to go. When the VIX is high, it's time to buy. So I have a chart where I'll show you. I put a 9-period RSI on the VIX, and we're getting kind of extreme in the oversold area. The S&P, it's gotten above both of the 50-period moving averages, the simple and the exponential, and now we're right underneath the 100-period simple moving average, and that's currently acting as a resistance, and that's just about at the 3,900 level. And this scenario that came about a week ago where there was a Wall Street Journal article that floated this idea, kind of like a trial balloon, where they said, okay, at the next meeting, the Fed's going to raise 0.75%, with possibly having a lesser increase in December. And that's kind of what the market's going with right now. That's why they're not really reacting to some of the negative news, some of the interest rate movements and so forth. For right now, the market feels like it knows what's going on. Now, that could always change. And it was pretty much only during Friday's session. We'll have to see if it can continue that way. We still have the 10 to the 5, the 10 to the 2, the 10 to the 3 month, the 30 to the 5. All those yield curves are inverted. So if you use that as a gauge to determine whether we're either in a recession or going to go in a recession, they're pretty much all flashing signals, at least the ones that I follow. Sentiment has gone back over into the greed side now, so it's more positive. We don't use this as a contrary indicator right now. It's just when we get extreme greed or if there's extreme fear, that's when we start looking to do the opposite. But while it's moving one way or the other, we tend to follow that. And then the economic reports came out. And again, the market could have tanked on this. Personal income up 0.4%, which was more than the 0.3% that they expected. Personal spending, again, up 0.6%, where they expected it to be up 0.4%. That was more than expected. The prices came in as expected. And then the core, this is the important one that the Fed uses for inflation. It was up 0.5%, which is more than the 0.4% that they expected. So the market could have just tanked on this news right here, but it didn't. In fact, it went up. And that's the sign of possibly things are changing. Even when there's negative news, the market tends to just throw that aside. We also saw the third quarter employment cost index come in as expected at 1.2%. And pending home sales, which we're still seeing this real decline in housing, they were down 10.2%, which is double what they had expected it to be down. Consumer sentiment came in at 59.9, still very low overall. People are not feeling very good about things, but a little better than it got all the way down to 50. And for it to come back up, at least it's showing a little bit of improvement. They expected it to be at 59.6. So this was a little better than expected. The last time we got this report, it was at 59.8. So we were up just slightly from that. Our trend is positive. The red line is below the green line, or the green line's above the red line, but it's still weakening. As those two lines are pretty close to each other, the ADX is declining. It's below the moving average, but it's still above 20. Our bias is now positive with that strong up day, and our momentum is still positive. And then just to update this, I haven't showed this in a few days because the World Series finally started. Philadelphia won the first game, so they're up 1-0. We'll have to see how things play out in all of this. All right, let's go back and talk about sentiment. Here's greed, where it's showing that we're at 61 now. And again, showing a lot of improvement, but not an extreme reading. And here, after we were extreme negative, it shows how sentiment has been improving. We also have the active asset managers. They're also showing some improvement. This is still kind of a low reading, but after getting really extreme, 20 and below, to now be at 53.91, that does show some improvement. Here's our weekly survey of individual investors. They have improved. They're not as extreme pessimistic as they were, but they're still negative overall. And then the latest reading of the RIDEX bear bull ratio shows that as we've been going up, people have been getting out of the bearish funds and back into the bullish funds. Here's the sentiment chart showing the blue line here. This is the 59.9 that we just read about. And we compare that to the 2-year yield, and these still are very far apart from each other. Again, what usually happens is they tend to move in the same direction, and they tend to not get very far apart, even though they're on different scales. Well, there's still a really wide spread, and that's what this bottom area is measuring down here. It's lessening a little bit, but this is still pretty wide. Here's some Isabel Net charts, and I have some extra ones because I didn't do a full-length video for Friday's session. This is the change in U.S. inflation around the start of recessions. So whenever it starts, we tend to see inflation really fall off overall over a period of time. This is what they're currently suggesting the terminal rate may be. I've seen it all the way up to 5%. But based on this chart, it's saying that we may top out at 4.86%. Then the conditional seasonality. This chart just shows during bull markets from this part going forward, well, I should say for the year, when we're in a bull market, that's the green line, and that tends to be up. If you go all the way back to 1965, if we're looking at a bear market, that's how things tend to go down. And then this is all of the years taken together where we still end up seeing some kind of advances over the long term. This is that some investors believe in quality outperformance over the next few months. They're looking for companies that have good quality earnings, that have a real track record of having earnings per share growing over a period of time, instead of the real catchy, flashy, stocks that are more fun to talk about at parties and things like that. Folks are looking more for quality now instead of being in the latest and greatest stock. And that's really high as of the current reading. Then this is the equity allocation. Right now it's at 60.5%. It has fallen off, and folks are still more weighted into stocks, but it has been coming down as we've really struggled in 2022. This is the economic output composite index against the leading economic index. And they just show that where the composite index has been going down, as the leading economic index has also been going down, which again may suggest that things are going to be kind of difficult for the economy going forward. There's another one, the Bloomberg UST, okay, this US Treasury. This is the MOVE index. This is the VIX of bonds. So you have the MOVE index, which is the light blue line. And then this is the Bloomberg spline error, for whatever reason that they do that. But again, these have a tendency to move in the same general direction. But what we're seeing is the blue line is currently, the light blue line is below the dark blue line. And during healthier environments, typically you will quite often see the light blue line on top. Then we have the CEO confidence. It's plunged to a record low. Could we use this as a contrary indicator? They ask a lot of CEOs, what's your outlook for the economy looking ahead 6 months? And they're not too happy about things right now. Well, could that mean that maybe we're getting to a bottom in the economy? Then here's the probability of recession calculated from the yield curve. Now, they take into more account more yield curves than what I use, but this is what the forecast is right now, that there is a pretty high probability that we will go into a recession. And as this goes up, that just means that the chance of a recession is even greater. But then a lot of folks think that we've already been in a recession, and your personal situation, you might be in a recession. But we had 2 negative quarters of GDP, which is a textbook definition. But then this past week, GDP came out as positive. So are we going to see what might be called a double dip recession with GDP going back down? Here's the percent of 10 yield curves that are inverted. And it just shows that that's topping out and possibly starting to roll over here. A recession is imminent when 50% of yield curves tracked enter inversion. And all the charts that we show are inverted. And right now we're at about 60% right here as the stock market has been coming down. So this suggests that the economy is going to be weak going forward from here. There's the year-to-date share buyback in 2022. It's really rising. And these are also announcements that they make where they intend to buy back stocks. Maybe they haven't done it. It's up 8% on a year-over-year basis. That's usually a pretty healthy sign. When a company is willing to go in and buy its own stock, that can help support stock prices because there are fewer shares on the market. And just the fact that a company is willing to take its own money and buy its own stock, that can be positive as well. Then here's new one-family houses sold in their whole total here. This is, and we're seeing this decline here. That's the dark blue line where housing is really having some trouble currently and declining. Here's the inflation shock. Here's how inflation has really shot up in the US, Germany, and in the UK. Not a big surprise there. All right. So growth really did well, up 2.62% versus value that was up 2.22%. And except for the mid caps, the growth underperformed, but small caps really performed well. The VIX is really starting to decline. And even when we had that down day on Thursday, the VIX still declined. Does that mean that people aren't worried about hedging? They're getting more positive on the market, so they're not really as concerned. Because usually when we have a down day, the VIX goes up. That didn't happen either for the S&P or the NASDAQ on Thursday. Well, it just continued to decline on Friday, and the VIX of the VIX is coming down. And we're getting to a pretty low reading here. We haven't been this low in a very long time. And this is the chart that might produce a bit of a warning flag. As the VIX has been coming down, our RSI of the VIX, it's starting to get extreme negative. You can see other times when we went to this level, right down in here, I guess that was right in this spot, right in here. Just something to be aware of, that if the VIX, if the RSI is going to turn back up, it's because the VIX is going up, and the VIX usually goes up when stocks are going down. Our Ulcer Index is also showing more of a bent towards the greed side of things. That kind of lines up with our sentiment indicator. Maybe not as extreme as what this chart is showing, but it just shows that fear has really come down. We're down 19.04% from the all-time high. And this is looking pretty good, even though we have some resistance above us and where we're at right now. The fact that we were able to break out of this has really helped a lot of our charts to improve. The equity put call ratio has declined with the up day, and our 5 period, it's still ticking up a little bit, but we're working off of this spike that was set right at the end of September, seeing if that can give some support to stocks. Here are the support levels for Monday's session, which has been posted on the YouTube community channel page. And here's the daily chart showing how we broke above this. We're above the 50-period moving average. We're not out of the woods by any means. We still have some resistance to deal with, plus a pivot point above where we're at, plus we have the 3,900 level. Then if you look at the bottom, we saw the volume was above average. Our short-term fib levels, we have been breaking out of resistance, but we still have some other resistance here at about 3,910. So if we can get above 3,900 and then eventually work our way up to 3,910, can we even break back above that? And these are very short-term fib levels. If we do start to decline, we're going to still keep an eye on this double fib level going from the August high down to the October low, and the other fib level that's right on top of it going from the September high down to the October low. This could be pretty significant support if we see some declines. Then longer term, we did break back above this double Fibonacci level right here. So this is really showing some improvement. The fact that we're going up and we're breaking through pretty significant resistance. But if we do decline, that should turn into support if we start to come down. We're going to keep a close eye on that to see if that holds up. Also, on the weekly chart, this is much longer term. We broke back above the 38.2% retracement. So a lot of improvement is happening here on these charts. We're well above the 200-week moving average. The 50% held up. And so this is showing quite the improvement. We're back a little bit above the midpoint right now in our trend channel. The sectors, we had 10 out of 11. I guess they were all up. I saw something else where 10 out of 11 were up and one was down. Discretionary didn't have a very good day, but all of the other sectors really did well, led by tech at the very best. And you have energy with the chart that's still looking the best, followed by healthcare. The industrial sector has now gone into the 90s, as have the financials. And then down here, communication is now back in single digits. Real estate, which had been in last place, has now seen some improvement. Here's the energy sector up 55.59%. My goodness, since the all-time high, followed by healthcare and then utilities. Even though we've seen some improvement with communication and discretionary and real estate, they're still heavily down since the all-time high. Here are the percentage changes with the pink. That's the S&P and just how the indexes have changed. We need to see follow through from the NASDAQ and the NASDAQ 100. That's the growth part of the stock market. As far as our technical alerts, most of them were positive. The utilities did start off by having a bearish death cross, basically. The 50 crossed below the 200. That could also give some support to stocks because that's our ratio. We have the S&P to the utilities ratio chart that we look at. And so we want to keep an eye on those things. The NASDAQ got over 10.8 and then 10.9, 11, and then 11.1. The S&P did get above 3,900. We had the real estate sector give a BPI cross above 70. Above 50, and the materials had a BPI cross above 70. So a lot of technical improvement has been happening. All right, we have the Dow. Look at this, 95.7. That's a healthy looking chart right now. In second place, small caps at 86.9 and mid caps at 80.3. In fourth place, improving but still not looking real strong, is the S&P 500. And even though we're seeing some improvement with the Qs, with the NASDAQ 100, it's still in last place. Intraday, so we had a higher opening, and this is the wrong chart. Okay, I put the wrong chart right in this spot. I'll try to work off of this anyway. So we did have a higher opening. We came right up to the daily pivot, and then we were eventually able to break through R1. We went all the way up to R2 and then ended up closing just about at the high. Here is the other pivot chart for Monday's session. Here's our trend showing how the green line is on top and advancing with a declining ADX. So this is a positive weakening trend, according to this chart. The Arun, man, it really shifted over it. Once we broke above this, it really kicked into gear. We have buyers well in control with sellers falling off. And so we're seeing a great improvement with the oscillator. Breadth is showing some improvement, but we're still underneath the moving averages that are declining. But we're seeing a lot of really good, powerful updates, a lot of green really pegged to the top, both with price and volume. Advanced decline ratio showing some improvement, starting to get a little extreme with our 19-day exponential moving average. That moves faster than the 39 exponential moving average, but both of these are positive currently. The highs and lows, as we broke above this, we saw a real kick for new highs. And so that is just showing an improvement with our 5-period and our 10-period study. We're right about on the moving average with our accumulation distribution. We want to see this break above it and see the moving average actually turn back up. Short term, this is where we're overbought. This is a one-day chart of the advanced decline ratio. We're just barely into extreme positive territory. And then we've come back. We're still above the 20 and the 50s. Now we're dealing with the 100-day moving average. That's the purple area. And here's our rainbow, just showing how we've worked through the 10, 20, 30, 40, and 50 and those moving averages. So we're actually coming up out of that rainbow a little bit. And then rate of change from Thursday to Friday also suggests that we may have overdone it. 5-period may have overdone it. 10-period we may have overdone it. Stochc RSI, extreme positive. Williams percent are extreme positive. The force index not hitting the Keltner band, but giving us a pretty high reading. I would still say this is positive, but some of our other indicators suggest that we're overbought. Like this one, the Swindling Trading Oscillator. We're starting to get extreme positive based on price, but we haven't quite got there based on volume. McClellan Oscillator. This is extreme positive. And our 20-period moving average study, extreme positive, but we're still positive with the 50 and the 200 study. The stochastics, yeah, we're extreme positive in the short term, intermediate term, even rolling over a bit, but we're looking better with our longer term stochastics. Intermediate term, we're showing some improvement here. We're well above the 50-period moving average. Now we're bumping into the 100-period moving average. Here's our intermediate term rainbow, where we're starting to come up into the underside of that. Can we continue to get to the 50, 60, 70, 80, 90 and stay where we're at now at the 100? Can we break above that and have this whole rainbow or ribbon actually start to turn more positive? Here's our moving average tree, just showing that we're right at the 100-day simple moving average. And the rate of change going back 50 periods, this is longer term, after being extreme negative, is showing some improvement. So this just suggests that longer term, we're seeing some improvement. Short term, we may have overdone it slightly. The Sean trend meter actually declined with that pretty solid up day. And our PMO continues to be positive. The PMOs that are rising, that's extreme positive. The buy signals are getting extreme positive. And those that are above zero is showing improvement. The Chaikin Oscillator barely turned up, but it's positive. Chaikin Money Flow looking more positive. And our volume did pick up in Friday's session. So volume, if we can see volume really pick up as prices go higher, that would really help things. The Vortex, the green line's on top, so that is positive. The summation index based on price and volume continue to advance. The volume has crossed above the zero line, so that's positive. We haven't got up to the zero line yet based on price. All of our oscillators continue to be positive. The BPI is positive right now and has really showed some strength as we've been moving higher. Ease of movement showing improvement, that's positive. Ultimate Oscillator, positive. Money Flow Index, positive. CCI 14, looking a little extreme, as we are with the 20 period as well. So that's a little bit of an overbought indication. Our percent B indicator, we're getting right near the edge of being extreme. That's when we get up to the upper Bollinger Band and actually go above that. That often means that we've gone too far too fast. TTM squeeze showing a lot of improvement. And these little dots down here have turned to green. That's also positive. Balance of power is looking more positive. The CMB composite index, after giving us kind of an extreme reading, it actually declined a little bit. And we've been able to get back above this anchored moving average, going back to the COVID low. That is positive, that we broke above that and then closed above that. Our Heikin-Ashi chart is still looking much improved. So that's positive. The Kagi chart is positive. The Renko chart, we have 2 open boxes. That's positive. 3-line break is positive. We had a new X drawn in with this bearish signal reversal or reversed. So it was giving us a bearish signal, and then we saw some strength coming up out of that. So it's liking that. It's taking that as a positive signal. The Elder Impulse, it actually switched back to neutral after Thursday. It went back to positive after Friday. Same thing with the SPY. Our SAR continues to be positive with the dots underneath. Here's a new signal. The go, no go has flashed a go. That's a buy signal. Long term, we actually turned down a little bit with our 50-period moving average. All of our moving averages, 150 and 200. That's kind of strange. Yeah, I did update this chart. It actually looks more like Thursday's chart. The rate of change, this is another long-term indicator that is trying to show some improvement after being extreme negative. Special K turning up. That is positive in and of itself. If it could eventually get back to this moving average, that would be even more positive. Going back 250 periods after coming down and hitting the COVID low, This chart is also trying to improve. The diamonds, this is the best looking chart right now, is the Dow with a lot of green bars. And we've actually been able to close above the 200-day moving average. Haven't been able to say that in a long time. But beware, it's the S&P that we really want to look at. We broke the 200-day moving average back in August. The S&P went right up to the 200-day moving average and then tanked after that. The Dow was only 30 stocks, where the S&P 500 is 505 stocks. So this is very positive, but don't let it fool you necessarily. We want to be cautiously optimistic. Elder impulse for the Qs. It actually switched to negative after Thursday and now back to positive after Friday. And we're right up to this pivot level in the NASDAQ 100. Can it break through? Can it get to the 50-period moving average? The Vixen, which has just been all crazy with its intraday bar data, but it's another suggestion that what's going on here? Because even with Thursday's down day, we'll have to look at the line chart. It actually declined, and it declined in Friday's session as well. The NASDAQ also coming up to the pivot point here. This could be overhead resistance. We're still underneath the 50 and 200-day moving averages. This is what's really going to have to kick into gear, this in the NASDAQ 100, if we're going to see a more sustainable improvement. The mid caps also above their 50-period moving average, but not up to their 200 yet. And the Wilshire also above the 50-period moving average. The Dow, that just really did well. And the transports, they're lagging a little bit. This chart isn't going up as strong. We're seeing some improvement from the utilities, but it's still producing a bit of a negative divergence because of this big, sharp drop that we saw here. The dollar, it was actually up. That's another strange thing about Friday. Not very much. It was only up 0.14%. But usually when the dollar's down, that gives support to stocks. Well, the dollar was up and stocks were up and interest rates were up. Here's the S&P to the dollar. They're still having a pretty strong tendency to go in opposite directions, however. Gold, down over 1% and below the 50-period moving average and in a downtrend. Silver was down 1.33%, just above its 50-period moving average, and continues to be in a downtrend. Oil was down to 87.90. S&P 500 to oil, they're getting back to the point where they're having a tendency to go in the same direction. Bonds, a little bit of a decline here with our ETF, about 0.25% decline with our world bond index. And here's the yield curves. The 10 to the 5 is still inverted. The 30 to the 5 is back to being slightly inverted. The 10 to the 2 is inverted. And this is the one that was kind of the holdout for a long time. Well, the 10 to the 3 month remains inverted. Yields, after really spiking up, had been coming down, even though they bounced up and were a little bit over 4% for the 10-year on Friday. And we're just showing how interest rates have really been breaking out, even though there's been some recent pullback. Here's the 30-year, after spiking up to 4.4%, have come down to 4.15%. And we still have the 2-year, which is giving you the best yield. And we did see an increase pretty much across the board with interest rates, but stocks still went up anyway. Our correlation between stocks and bonds having a slight tendency to go in the same direction. The S&P to the 2-year still having a tendency to go in the opposite direction. And the S&P to the 10-year just on the verge of neutral, but heading down to the point where they might start moving in opposite directions. And here's tech to the 10-year. They are neutral in that relationship. Our scenario showing some improvement. In fact, maybe a little bit too much improvement. With our 19-day exponential moving average of the advanced decline ratio, we're starting to get extreme based on price. We're not quite there based on volume, but this is really showing a lot of improvement. And stocks above their 200-day moving average also showing some improvement. Stocks above their 50-day in the S&P going up. Mid caps going up. Small caps going up. The 10-day average of the highs and lows in the S&P, it crossed over the midpoint here and is showing improvement. When you take the whole market, we're still negative overall with our 5-period highs, lows moving average, but this is showing improvement. And here's our equity put call ratio going back 5 periods. We're still working off of this spike. And overall, even though the VIX went up, why do I call this the VIX? The equity put call ratio went up a little bit. It still is declining overall. Small caps had a pretty good day, up over 2% on Friday, above their 50-period moving average. And so we're seeing small caps outperform the S&P, which could help this chart. We're seeing the red start to spike up. 1, 2, 3 days after or so, sometimes when this red line spikes up, that provides the opportunity for the blue line to spike up, which is the S&P 500. And then our sector rotation showing a little bit of improvement with the Qs to the S&P, still declining with discretionary, and large cap growth against large cap value, just not doing very well right now. And then our growth value ratios for the large cap, pretty much flat to declining, right on the moving average with the mid caps, and actually declining a bit with the small caps. This is that chart that's really kind of helping us right now. As utilities have been going down, the S&P's been going up. Even though we're coming off of our high, overall, we're still seeing an overall uptrend with this ratio. Can that continue? And we don't know about the 2-year spike because it just keeps going up and up and up and up and up. So we have to wait for it to turn down to see if a spike is even created. The staples were up over 2% as well. We have not taken out the spike that we're working off of right now. We're getting close, but if this could turn around and really start to go down, that would give a lot more support to the S&P growth to go higher. Copic curve, still giving us a signal. The praying bottom fisher looking a little toppy here. It's starting to roll over a little bit, but this is still a valid signal. It's looking to get a little exhausted now. All right, so our outlook for Monday, the technicals are positive, but we're short-term overbought. And we've kind of been saying that for a while now, especially when we're in a range and we bounce around in that range. It doesn't take very much for us to become short-term overbought or oversold. And then we have the FOMC announcement, which will be on Wednesday on the 2nd at about 2 p.m. Eastern time. On Monday, we have the Chicago PMI coming out. That's the only economic report. The whole list of geopolitical events with the election coming up this week and the Fed meeting, and then the markets being fixated on inflation and interest rates, even though that really didn't happen in Friday's session. The market just wanted to go higher. Didn't really matter what the news was. So our scenarios, we're not with the down scenario currently, but any one of these headwinds could come back in and push us down. What also could push us down is if the market deems itself as being overbought in the short term and we see either sideways or to a decline. If we do start to decline, we're going to be watching the intensity of that decline. We're going with the positive scenario right now, although we are overbought in the short term. But we've been that way most of this last week, and the market, even it had some down days, but overall, it's still been going up in spite of that. Our scenarios are showing some improvement, not so much with our sector rotation, but our positive setups are showing some improvement. The technicals, a lot of improvement. We're regaining moving averages. We're getting above pivot points and fib retracement levels. Now we're dealing with other levels of support or resistance. And then we're not really sideways because the ADX is still above 20, although it is declining and we are in a positive trend. So our conclusion, the S&P is turning positive, but it's overbought in the short term overbought, intermediate term, it could be becoming overbought with the CCI charts that we're looking at. And if we see some other charts really start to get extreme positive, the intermediate term would become more overbought, but it's not, it's just kind of loosely overbought right now. Long term is showing some improvement with our longer term charts, but until we get above that 200-day moving average, we are still negative. So thank you. Have a wonderful weekend. I will be preparing the weekly video as well as the intermarket analysis video and posting those as soon as I can.